Hi, I'm Derek Pesta with Pesta and Pesta Wealth Management, and we've been in the game now for over 55 years, serving more than 180 families. In this video, I'll walk you through the 3 biggest mistakes we see tech professionals make when it comes to taxes, mistakes that quietly cost hundreds of thousands of dollars over time. I'll break down each mistake, why it happens, and go over a better approach for each mistake, especially if you're holding RSUs, other forms of stock-based compensation, or if you're planning for an earlier retirement than most people. First, let's get into mistake number 1, letting taxes be an afterthought to investing. Most tech professionals we work with are great at building wealth and accumulating wealth, but they really let taxes be an afterthought to their investments. The way I like to think about taxes and how it plays in part to your investment strategy is that you really want to make sure that you're doing the basics year-end planning, but also throughout the year. I kind of equate it to living a healthy lifestyle, working out, eating healthy, getting enough sleep, drinking enough water. These types of things you really need to be doing day in and day out. So for example, you need to make sure you get 7 hours of sleep. You need to make sure that you're working out 3 to 5 times a week. Maybe you're cutting out sugary drinks and excessive sweets. All of these things you need to be doing may seem small at first, but once you get a couple days or a couple weeks or a couple months or even a couple years under your belt, that's when you really start to see that progress. Well, the same thing happens when we're talking about tax strategies. So for example, you may have a 401k at your work, and by doing that, you're able to put money into that 401k, and if you're doing it on a pre-tax basis, you get a nice tax deduction each year. And most of the tech companies that our clients work for, they have what's called a mega backdoor Roth 401k option, which allows them to put even more money in there and be even smarter about their tax strategy. Or maybe you're young and you're healthy and you don't spend that much money on health insurance. Maybe it makes sense to look at setting up a high deductible plan, which allows you to enable saving into a health savings account each year. Or for example, maybe you and your spouse have been maxing out your 401ks for many years, but you've always heard about this thing, backdoor Roth IRA, and maybe you didn't really know what that is. Maybe now is a good time to implement that. These small things can help you build up wealth and save more money on your taxes. Or other things such as tax loss harvesting. If you're being smart about this, not just at the year end, but throughout the year, these small singles and doubles, these small steps that you build into your habits each day can really help out. And the reason why I bring this up is that just like living a healthy lifestyle, the same thing goes with your taxes. You can't go back a year or 2 or 3 years down the road. You can't go back in time and do these things. Once the calendar year is up, it's too late and you've missed out on these opportunities. Some of the other companies in Silicon Valley have a similar structure where their employees are compensated based on non-qualified stock options. And the reason why this is unique is that there's usually a 10-year window where the employees can exercise those stock options. But what we've seen is that sometimes employees will kind of wait until the end of that 10-year term. So we really want to make sure that we're planning ahead of time so that we don't have to wait until the last minute and have some big tax bills in those last few years. So again, this is another mistake or an example of how this mistake can really be an issue that you want to work through. So overall, mistake number 1 that we see is letting taxes be an afterthought to building wealth. Let's move on to mistake number 2, exercising or selling RSUs without a plan. Why does this mistake matter? Well, a lot of tech professionals we meet, they think of their RSUs kind of as newfound money. It's something they just tap into or sell whenever they need it. For example, maybe they need to buy a new home and pay cash or use that cash as a down payment. Most of the time these things happen, and when this happens, it gets taxed and stacked on top of their income from other sources like their W-2 wages, their salary, or their bonus, or other forms of compensation. So how does a better approach actually look like? Well, for some of the clients and families that we serve, a lot of them work at tech companies, such as Apple, and they get RSUs as a form of their compensation. So one of the things that we want to be strategic about is what are their goals? Are they looking to potentially pay cash for a house, or are they looking to save up cash for a down payment on a home? If that's the case, maybe it makes sense to start putting up a schedule together where we systematically sell those RSUs each vest. And by doing so, we're able to carve out portions of the RSUs, have that money in cash ready for the down payment. And the reason why that's important is because it also limits any future capital gains on the growth. And because these are shorter term goals, we want to make sure that we're carving off these RSUs and saving them as cash so that we're not subjecting ourselves to the market volatility of the stock, such as Apple or any other company that they're working for. Another reason why this is important is because I like to think about it in terms of gardening. And so when we're gardening, we're doing things like harvesting our crops, pruning them for the winter time, watering them, replanting them, or looking at other ways to keep our plants healthy and strong, maybe putting nets around the plants to keep the bugs out. All of these things are very similar to, for example, RSUs. There are things that we can do each vest to help plan for your goals. If, for example, you think that the stock is really going to perform well, you don't have any short-term or mid-term goals that you need the cash for, maybe it makes sense to look at other opportunities to prepare for future distributions or needs to sell the RSUs and diversify. Even if you don't, we have some great strategies that we've been working with our clients that are able to help capitalize on this preparation, such as tax-aware hedge funds that help with this, or even long-short strategies that help. So these are the strategies that we help our clients prepare for so that they don't run into any surprises down the road. We really want to make sure that there's a plan for their RSUs and make sure that when we're looking at the exercising or selling RSUs, we want to make sure that there's a plan and that we're not just waiting until the last minute and having an unexpected tax bill. And finally, mistake number 3, waiting too long to think about taxes in retirement. Many tech professionals think about taxes in retirement as something that happens well later down the road. One of the things that you want to be mindful of is that taxes in retirement, if you deal too late, can have a negative tax impact overall. And what we're really trying to do for our clients and for our families is help them reduce their overall lifetime tax bill. Things that we're helping out our clients with and think about and strategize around are things like Roth conversions during retirement, when their income tax bracket most likely is lower than when they're in their highest income tax years, when they're working and earning a high income. Also, things when you're looking at in retirement are charitable giving. Things that can help you include looking at ways to give from your IRAs when you're in your 70s. These can be very impactful for helping you not only give more to charities, but help you save on your taxes. Another thing that you can do is being mindful of how you source your retirement income. So for example, are you going to pull money from your IRA account? Are you going to pull money from your Roth IRA account? Are you going to pull money from your trust account? And then how are you going to pull money from each bucket? What's the ratio? Are you going to do 1/3, 1/3, 1/3 each? Or are you going to look at pulling from one account more in your earlier years? And are you going to look at pulling from the other types of accounts later down the road? These are the things that you really want to be strategic about and have a plan for, because everyone's plan is a little bit different. Some clients are going to spend more than others in retirement. Some clients are going to have kids and grandkids that they want to leave a legacy to. Others may not have kids and may not need to worry too much about those types of things. So everyone's situation is a little bit different, but that tax question, that tax strategy is going to be very important no matter which family we're helping, because at the end of the day, we know 2 things in life are certain: death and taxes. When we're working with families, we know that each family is unique. Some clients have kids and grandkids, and they want to make sure that they're passing on some of their wealth to those future generations to leave a legacy. Other clients may not have kids, and they're really looking to maximize the amount that they can spend on travel or donating to charities that they're passionate about. Whatever it may be, each client's going to be a little bit different. But one thing that all the families we serve have in common is that they're looking for ways to be smart about their tax strategy in retirement, especially as it comes to the way that they're going to be pulling money out and being smart about it. Another thing that we also help our clients out with is not only about the taxes around how they're spending it or their investments, but an important thing for many clients these days, given the new amount of wealth that's been created, is looking at estate taxes. And as an example, a lot of people that we work with, for example, in the tech industry in Silicon Valley, especially those at NVIDIA, where we've seen a huge amount of wealth creation, is that they're sitting on more wealth than they've ever had before. And a lot of these clients are having $15, $30, $40 million in net worth. And when this happens, depending if they're single or married, this pushes them into a situation where they're no longer having to worry just about their income taxes. Now they're having to look at their estate taxes. And so one of the things that we look at doing are having conversations around this. Does it make sense to start looking at putting stocks in an irrevocable trust so that we're getting those out of their estate and limiting the amount of estate taxes that may be due? Because estate taxes can push the tax rate close to 50% pretty quickly. And so we really want to be smart about estate taxes if this is the case. For example, Jensen Huang, CEO of NVIDIA, back in the late 2000s, he started putting his NVIDIA stock into an irrevocable trust, knowing that all the work he'd been doing for the last 10, 20 years was probably going to come to fruition. And because he did that, he was able to put a lot of shares in at a low price. And now he was able to exclude a lot of that wealth from his taxable estate. This had a huge impact on the amount of money that he's able to save in taxes, thus leaving more for causes he's passionate about, but also leaving more for his family and other heirs. The common denominator across these mistakes is that many firms treat taxes and investments separately. At Pesta and Pesta, we plan first and then advise. If you've built up over $3 million in assets, but still feel unsure about how taxes affect your long-term plan, that's exactly who we help. If you're ready to explore what a more integrated approach could look like, book a call by using the first link in the description below. Thanks for watching.